Thank you very much, Katia, for being here today with us, and it's a pleasure to have you here. And also thanks to all the people that are attending this meeting, this new meeting of the Phinance Online Seminars. And today we are going to talk about dark pools, and Katia Colaneri from University Tor Vergata of Rome will give a talk titled Trading in Dark Pool Benefits and Drawbacks. And so I leave the floor to you, Katia, and thanks again for being here today.
Okay, so thank you, Emiliano, very much for this invitation and actually the opportunity to review some of the concepts about dark pools. I've been working on dark pools more from a mathematical perspective, actually, because I'm a mathematician, as some of you know. So the reason why I got interested in dark pools at the very beginning was the fact that this, I mean, I'll give you some details of what dark pools are, but roughly speaking, these are alternative trading venues, and they are typically parallel to the standard exchange. So the reason why, in fact, I was interested in that was mainly for studying what from the mathematical point of view, the best strategy that one would actually apply if has the possibility to trade both in the standard exchange and in a dark pool. And a dark pool has some characteristics that are very, I mean, some of them are similar, but some of them very different from the standard exchange. So what an investor would do to make the best out of their trading when they have also the opportunity to trade in a dark pool. Okay, so what I want to do today actually is, without being too technical, actually on the mathematical side, so to say, I would like to tell you what dark pools are, what are the main characteristics of dark pools, and what are the possible benefits and drawback of trading in these trading venues. So I think that I can make full screen. Okay, so you see it full screen, right? Okay, so this is more or less the outline of my talk. So I'll tell you what the dark pool is and give you a few information about the history of dark pools, why they arise essentially. Then I'll discuss a few characteristics that are common to all dark pools. And finally, I hope that this gives a start to a debate of what would be the benefits and the drawback of trading in a dark pool. Okay, so starting from the definition. Okay, so what are dark pools? So dark pools are alternative trading venues whose main clients are institutional investors, typically pension funds, mutual funds, hedge funds, banks, and private equity funds. And what these clients can do actually is to trade anonymously, meaning that they can place an order without revealing their identity, with a minimum or even no price impact, so without affecting the price at which they are buying or selling shares of a certain inventory. And they also get better quotes, because usually the trades happen at the midpoint between the best bid and the best ask, which are publicly available on the standard exchange. Now, why is this possible? Well, actually, essentially why there is no price impact, and this is essentially because pre-trades information about the orders that are placed in these venues are invisible to the public as well as to the other participant of the pool, and details on the trades are shared only after the trade happens. Okay. So we talked about price impact, and I don't know if everybody knows what price impact is. At least I didn't know that when I started working on this topic a few years ago. So price impact actually is a move in a price which goes in the opposite direction of a certain order. So typically, if you place a selling order in the market, then you get, so then the price decreases, because essentially the market perceives this type of information and pushes the price down. So put in other words, so market participants detect from the order the volume of that you want to sell, and they naturally adjust their bids downward. And of course, if you want to buy, this goes in the opposite direction, so the prices are adjusted upwards. There are essentially several different types of market impact that one may imagine. There is, of course, a temporary impact, which typically affects the price instantly and then it disappears immediately. There is a kind of a permanent effect, meaning that the price goes down and it takes quite a bit before getting again to the level before trade level. And there is a transient impact, which essentially means that the bids are adjusted, but they then decay over time, which is essentially what happens in reality. And how strong the price impact affects the price itself typically depends on the volume. So the amount of quantity that you want to buy or sell, the speed at which you want to buy or sell a certain inventory. So for instance, you want to get rid of your inventory in one day, then of course this has, depending on how big is your trade, this has an impact on the price that you get out of the market. And clearly it also depends on the liquidity. So if the stock is very liquid, which means that it's very easy to be exchanged, then the price impact is not really consistent. And so the price impact is a topic which has been widely investigated from a mathematical perspective, starting from the pioneering paper by Bertsimas and Lowe, then Almgren and Chris, and actually there is a very huge literature that tries to explain how to minimize the price impact if, for instance, you want to liquidate a certain position, or you want to build up a certain position. So this is kind of a well understood topic, both from the financial point of view and also from the mathematical point of view. And now, of course, having somehow a venue or an exchange venue where you can ignore the price impact, so where your price is not affected by this type of impact, is very beneficial, especially if, for instance, you want to buy or sell a large quantity of a certain financial instrument. So this is somehow one of the biggest advantages of trading in a dark pool. So how do the dark pool operate? Then essentially they match buy and sell orders exactly as in the standard exchange, as they come into the pool at the best available price. And typically this is so you don't know exactly at which price the trade happens, but this price is typically the midpoint between the best bid and the best ask available in the standard exchange. And typically the dark pools operate as limit order books, and they execute trades based on the price and time priority. And just because I didn't know what if the audience is familiar or not with the limit order book, and I just want to give you a rough idea of how limit order book works. So in the market, there are essentially two types of orders that one can submit. The market order, which is typically a more aggressive order, where you indicate your willingness to sell or to buy a certain quantity at the best available price. And typically, these type of orders get immediately executed. And there is another type of orders which are called the limit orders. These are somehow passive orders where you indicate your willingness to sell a certain maximum amount of maximum quantity at a specific price that you decide in your order, and which is usually higher than the best buy if you want to sell, and lower than the best ask if you want to buy. So typically they are somehow orders that are more difficult to be executed because they are not at the best possible prices. You don't want to execute these somehow you don't want to sell cheap or to buy high, and therefore they become more difficult to be executed. So in this case, then the execution is not immediate, because of course you want to wait for a matching order somehow that of the same type. So there must be someone, if you want to sell, there must be someone that wants to buy at the same price. And especially for orders that have a limited amount of time. So for instance, you want to execute the order immediately, or you have for instance, 1 day for executing the order, it may happen that at the end of the day, the order is not executed. So in this case, execution is not immediate and may even not occur. And the limit order book keeps track of the incoming order and the outgoing order. And in most of the market, what happens is that the order are executed giving priority to market orders over limit orders, and using this price time priority. So if a market order arrives, then it gets executed at the best available price. And then if for instance, say that you want to sell, then this order gets executed if there is an order, a buy order of the same price, and if the buy order is not large enough, then you go to the second best buy, and so on. So that's more or less how a limit order book works. And this mechanism is somehow also considered in a dark, is somehow also used in a dark pool. Okay. Now, of course, just feel free to interrupt me if there is anything which is that is not clear. Okay, so I hope that more or less we have understood how. So what is somehow the definition of a dark pool? And now I want to tell you why these alternative venues arise. So here is more or less the brief history of the dark pool. So essentially in 1979, the Security and Exchange Commission allowed, changed the regulation and allowed any security that is listed in a given market to be traded privately. And somehow this new regulation, which actually was born from the willingness of the traders to somehow not to show what they wanted to sell, when they wanted to sell, and also the price at which they wanted to sell or buy, gave a rise of this somehow alternative trading venues. The first dark pool actually was launched some years later in 1986 by the Eastinet, and it was called After Hour Cross. So the goal of this dark pool was to execute orders after the closure, the closure of the markets. And just 1 year after, in 1987, the first dark pool operating intraday orders was born, and this was called POSIT. Both these two dark pools still exist. Okay, so the dark pools essentially as somehow some private markets where the orders could be executed without really showing all the quotes, so the vital information for the market, remained essentially unregulated until 1998. When the Security Exchange Commission introduced some regulation on dark pools. These are called the regulation ATS. ATS stands for Alternative Trading System. And with this regulation, the dark pools were required to register either as an exchanges to the SEC or as a broker dealers with a financial industry regulator authority, and that's they were subject to the same rule, to the same trading rule of exchanges and broker dealer. The advantage, however, of dark pools was that they still did not require to publicize their quotes, which was somehow in contrast to what happened in the usual standard exchange. And of course, this was somehow the introduction or of the dark pools within the regulated market. Okay, so now after that, then a few other regulations actually affected the dark pool. The first one was the next one was in 2005 with the adoption of the Regulation National Market System, which essentially promoted, in some sense, the fragmentation of the market. The main aspect of this regulation was the abolishment of an earlier rule that protected manually submitted exchange non-electronic quotes. And therefore, they somehow enforced the use of electronic trading venues. And this, of course, has contributed in a sense to the fragmentation of the market, but has also gave a push to the use of dark pools. And so this, all I said about the regulation is what happened in the US, and in 2007 some similar direction were introduced by the Market and Financial Instrument Directive. Okay, so between 2005 and 2018, the SEC proposed the new set of regulations for the dark pools. Some of them were finalized in 2018. And what is now the nowadays situation of the dark pool? Well, actually nowadays there are more than 60 dark pool operating as alternative trading system in the US. It's a little bit less in Europe, but still they actually elaborate a consistent percentage of the trades. So one important date actually was, I mean, at least one significant date was 2017, and this is because in 2017, then more stocks were exchanged in the dark pool than in the New York Stock Exchange, which was somehow a big achievement for the dark pools themselves. Okay, so, and this plot actually shows the development of the dark pools in the last 3 years. So as I was saying to Emiliano before, giving this talk actually gave me the opportunity to review what happened in the last few years to dark pool. And what I discovered actually is that in fact in the last years the dark pools gained a very huge percentage of all market trades. This is the situation in the US, and the source is the Financial Industry Regulator Authority. So that's quite, this is quite somehow reliable source. And as you can see, there was kind of a big push to the use of dark pools starting from 2020. Okay, so in a sense, we cannot somehow ignore the presence of dark pools because they are there and they are becoming more and more important. Okay, so then one somehow may ask what enforced the rise of dark pools. There are essentially three main reasons. The first reason is regulatory changes. Now, as we said, somehow the SEC introduced in the US, introduced some regulatory change that somehow gave rise quite naturally to dark pools, and then they enforced the use of dark pools due to the next regulations. So this was somehow quite clear, quite important, but then there are other two important aspects that must be considered. The first of all, a better trading technology. Now, of course, the rise of the fast computers and the algorithmic trading has actually had a very vital they give actually an improvement to the use of dark pools, which actually work as electronic exchange. And the third reason actually is the decline of the market volatility. And this is somehow a fact that happened starting from 2009. And the reason why actually this has brought a big push to the use of dark pools is when typically when prices are swinging, so when the volatility is high, traders seem to prefer to go to the standard exchange and then use displayed price for their trading. When the volatility is somehow low, then there is an advantage to go to dark pool or other of exchange destination. That's somehow understandable because some of the advantages of dark pools, so for instance, the fact that the quotes are better and there is no price impact, but also there is this kind of absence of information. So these are somehow advantages of trading a dark pool, which are somehow weighted with the fact that not all the trades in the dark pool gets executed. And of course, if these trades do not get executed in a dark pool, then what happens is that either people have to go to the standard exchange after some time. And this delay typically is very costly, and also is somehow the source, one of the sources of the information leakage. So in some sense, they revealed that there was an order standing in the dark pool and that order was not executed, so they had to go to the standard exchange. So in some sense, they contribute to get the situation even worse. And of course, if the volatility is very high, then the changes in the price may be quite high, and also this delay does not help in some sense. Whereas if the market volatility is somehow low, then the prices are more stable, then there is of course an advantage of trading in a dark pool. Okay, any questions so far?
I have a question, Katia.
Hi, Melissa.
Hi. Yeah, maybe I misunderstand, but it seems to me that particularly in 2020 and 2021, I don't have the data, but from the circumstances of the world economy, I would suspect that markets were much more volatile in these years than before. So it's kind of striking that these are the years in which dark pools became much more prominent.
Yeah, this is true. So somehow this number 3 decline of market volatility is somehow what happened until a certain point. Okay. Then in 2020, things have changed a lot. Actually, I've recently read a paper that was studying exactly what actually pushed the use of dark pools rather than the standard exchange in this period. And there are many motivations for that. And some of the motivation was also related to the fact that so somehow this is a kind of a period of market stress. And this also has been affected by the fact that more people were at home. And somehow they use their time for the trading, and this was not somehow what happened in the period before. So somehow 2020 was 2020-2021 made a change, but it was for different reasons in some sense. It was not related to volatility or to other reasons. So this was really kind of an event that had to be studied on its own, and the reason have to be found in different so in different ways in some sense. That's more or less what I have understood from the last studies on this phenomenon. I still I agree with you that it was somehow surprising according to the reason why the dark pool arise. I mean, I will show you also that there are different types of dark pools, and some of them are more recent. And because of the rise of these new types of dark pools, then this has actually may have generated this increase in the use of dark pools. We will see this in a few slides. Okay, so. Okay, so the next reason why I mean dark pools were used more and more often is, of course, the trade execution efficiency. So typically large orders and also stocks might be difficult to be traded because of the wide bid-ask spread or because of the low liquidity. And then, of course, this is somehow overcome in dark pools because the execution price is the midpoint between bid and ask. And concerning the liquidity, I mean, there are different mechanisms that dark pool uses to match their orders, the trades. Okay, now what are the characteristics of dark pools? So the popularity of dark pools stem from their specific trade execution format and also their specialties. And almost all dark pools work as electronic limit order book markets. Some of them operated continuously over time in intraday, and some others actually execute the orders after the market closure. Some operate as a non-displayed limit order books, some other execute the orders at the midpoints. So there are somehow all these different dark pools have different characteristics, what I'm saying. Some accept immediate or cancel orders, some other actually accept orders that can stay for a longer time. So there are really quite a big variety of dark pools. And in 2022, as I said before, there are more than 60 dark pools operating in the US. These are registered dark pools with very different categories. So how can we actually put all these categories together? Well, actually, we could recognize essentially 5 different categories of dark pool according to their main characteristics. In fact, only the first 3 can be considered as mutually exclusive categories, whereas the 4th and the 5th are somehow some features that may be included in the other categories. So the first category actually is called the public cross network, and this is the category. This is somehow the traditional dark pool as it was taught from the very beginning. So according to the SEC, these are the systems that allow participants to enter unpriced orders for buying and selling securities, and these orders are crossed at the specific time from a price which is derived from another market, in this case, the standard exchange. So this is the typical mechanism that is below the dark pools. So you place an order, for instance, you want to buy a certain quantity or you want to sell a certain quantity, then these orders are crossed if an incoming order of the opposite direction comes, and the execution is done at the midpoint between the bid and the ask, for instance. This is not the only rule. So what actually, one of the main characteristics of dark pools is that you don't know exactly at which price your order is executed, but you know the rule with which the price is computed. So typically, you can always think about the midpoint. I mean, there are also different ways, for instance, the average daily volume and other ways of computing this price. But what you know if you trade in a dark pool is the rule with which the price is computed. But you, of course, you don't know exactly the price at which the order is executed. Essentially, because the bid-ask spread actually changes over time, and you don't know exactly at which point in time an order is executed in the dark pool. Okay, so the parallel cross networks, as I said, are the traditional dark pools. The most successful dark pools are, for instance, the deposit, the liquidnet, the pipeline, and the Eastinet. These are the names of this pool, and these are all registered with the Security Exchange Commission. Essentially, one of the characteristics of this pool is that they are operated by independent or single firms. And this is somehow in contrast with, for instance, the consortium pools, which are operated by different firms that are working together. And what is the goal of these pools? So the clients of these pools are typically the big institutional investors, and they actually aim at providing clients with low transaction charges, bring down the cost, for instance, due to liquidity, and give them the opportunity of trade the big orders at a more advantageous price without being affected by the price impact. Okay. And generally speaking, in all these pools operate without displaying the quotes, so they don't display the volume, the price, and the time in which the order has to be executed. But there is a subclass of these pools, which are called the advertisement pools, that essentially works by giving alert to traders with closely eligible shares to provide liquidity to the pool, and then being more able to fill the so to match the order. This is, however, public information, so this is given somehow to everyone, and this alert actually does not contain the whole information about the order that is placed in a dark pool, but it typically says that there is a dark pool in which that wants to execute somehow at the mid price some kind of order, so without actually specifying the volume, so that traders that are invested can place an order on the opposite direction. Okay, so this is somehow more or less all about this first class, so the first category of pool. Then the second category of pool is the so-called internalization pool. Internalization pools are somehow newer compared to the public crossing network. These are essentially run by investment banks that offer their clients some price improvements and lower transaction costs. For instance, Credit Suisse Crossfinder or Goldman Sachs Sigma X. They initially were intended to internalize the trade, essentially for cost savings. So they were open to the sell side in some sense, and later they also opened to the buy side of a firm directly. So the current trend actually is to include in this type of pools also some external liquidity partners to supply or take liquidity from the pools. There are actually issues that arise by introducing external liquidity partners, essentially because these partners are not integrated with the pool in the same way as the participants to the pool are integrated. And this somehow is one of the main criticisms that is done to these internalization pools, because this is subject potentially to information asymmetry or information leakage. Now, these internalization pools are the ones that actually have improved their activity in the last years. Yeah, so these actually are somehow the biggest part of this of the plot that I showed you before. Okay, so the final category, the final big category of dark pools is the so-called exchange-based pools that actually includes registered alternative trading systems and also hidden order types supported by electronic communication networks. Now, the main characteristics or the goal of this type of exchange-based pools is the fact that they wanted to increase the level of liquidity of the participant in the market. So somehow they have a different goal compared to the others. They do not really represent the big part of the plot that I showed you before. So I'm not gonna spend too much time explaining how they work, but what I want to tell you is that, for instance, the last two categories that are called the pink destination and the consortium-based pools are somehow non-exclusive dark pool venues compared to the others. So pink destination actually is more like a feature of dark pools. And So some of the dark pools may accept immediate or cancel orders, not necessarily only immediate or cancel orders, but may accept this type of orders. So they are typically operated by hedge funds and electronic market makers, and major customers are the sell side of the firms that are using the dark pool actually to ping them and to somehow detect whether there is an order placed in the pool and who is placing the order. So these are more or less the mechanism, and some dark pools actually do not allow for this pinging. Other dark pools do that, and the pinging effect actually has some disruptive consequences for the trading. We will see this in a few minutes. The very last category is the so-called consortium-based pool. And the consortium-based pools are essentially pools that are operated by numerous partners. These partners typically have their own internalization dark pool. So they use, in some sense, the consortium pool as a second level of liquidity provider. So what they typically do is to try to execute their order in their internalization dark pool, and if they cannot, because maybe there is not enough matching order coming, what they do is they go to this consortium-based pool as somehow a second trial to fill the as a way to fill the order. Okay. Okay, so I hope that more or less we have understood how the dark pools are working, and so what I want to do now is to try to discuss what are the benefits and the drawbacks of trading in a dark pool. So I selected some, but of course there are many others, and I hope that you also may come with some questions or issues that may arise from trading in the dark pools. So the purposes of the dark pools essentially are to reduce the transaction cost, make the price more stable, and so lower a little bit lower the volatility, and the trading efficiency. So they can provide better prices, they can provide no market impact, and they can actually execute. They might be able to execute large orders of, for instance, stocks or equities that are either not very liquid or with a huge bid-ask spread. So then one may ask, the dark pools are these kind of alternative trading venues that lives apart from the standard exchange, but they're not completely separated, because dark pools take prices from the standard exchange, and if an order is executed in a dark pool, that means essentially that it's not executed in the standard exchange. Then what are the effects on the individual investors putting orders in the standard exchange? Now, this is still not clear, because in fact the dark pools have as a main clients the large traders, and individual investors are not large traders. They are more price takers than people that can contribute to form the price. So it is not really clear whether how the dark pool may affect the individual investor. For sure, they do not affect directly the individual investor, so maybe the effect is somehow indirect. But the main concern are that the fact that dark pools may affect negatively the market quality, for instance, by increasing the quoted spreads, the effective spreads, or the short-term volatility. They may reduce the liquidity because essentially they are stealing the liquidity from the standard exchange and bringing this to the dark pool. But the big issue is that they may harm price discovery. Essentially, because if a trade is done in the dark pool, then this is done at the mid price between the best bid and the best offer. The exchange market does not really see that trades is happening. I mean, they only see them after the trade has happened, which essentially makes no effect on the, I mean, not exactly, but it makes a very small or negligible effect on the price in the standard exchange. Then it is not clear what the right price is, because is the right price the one in the standard exchange? Is the right price the one in the dark pool? I mean, this is still not very clear. So essentially the main issues about dark pools are related to the fact that this may affect negatively the market quality and may harm the price discovery. And some of these issues have been addressed by the Security Exchange Commission by making somehow, by bringing some lights to the dark pool. But this is still, I mean, somehow not enough, and that's because of this lack of information in the dark pool, which is the main characteristics of dark pool. So we cannot actually, I mean, if we, that's their main feature in some sense. Okay, so then what are the factors that root to the dark pool, and what are the effects to the market quality? Now, on these on these two questions, actually, there is quite some literature that tries to quantify, in some sense, the market quality and see whether the dark pool is actually affecting negatively or positively the market quality, essentially by assigning the numbers to some risk measures. And how does the dark pool affect market qualities? I mean, to me, it is really not, it's really not very clear. Some studies say that they are actually somehow improving the quality of the market. Some others say that they are actually bringing some, having some negative effect on the market quality. That essentially depends on the type of risk measures, the risk measure that you are considering. But what we can say is that typically trading in the dark pool is low when the volume is low, when the volatility is high, and in period of somehow market stress. And traditional dark pools, so the first category that I showed you before, is more active for largely capitalized firms, whereas internalization pools are more common for small caps. And I mean, there are several studies that show how the dark pool may affect the quality. So here there are just a couple of results from a very recent paper. This has been published in 2021 by Bindi, Buti, and Werner. There are some older studies by Zhu, by Mittal, and others. Essentially, these three authors, Bindi, Booty, and Werner, they have been studying dark pool for quite a long time. So their first studies actually date back to the beginning of 2000. And so they have collected a lot of data about that. And in this paper in 2021, what they did is to compare two different periods. Essentially, they took 2009 and 2020, and what they realized is that the dark pool brought, so improved the market quality essentially in 2009. What they looked at was really the quoted spreads and the effective spreads and the short-term volatility. And what they actually get is that quoted spreads decreased, so they became narrower, and the effective spreads as well in 2009, although the short-term volatility, for the short-term volatility, there was not significant, they didn't have significant result regarding this kind of risk measures. So what they did is that really actually study these three risk measure and show what happened when using the dark pools or the standard exchange. So what they realized is that the bid-ask spread became narrower in 2009, and that in some sense improved the market quality, and they became larger somehow in 2020, which was a period of market stress, and that actually worsened the market quality in the standard exchange. So the dark pools actually worsened the market quality in the standard exchange. And what they also observe is that starting from 2020, actually the percentage of trades in the dark pool increased a lot, and that was essentially what I was saying before. So they actually attributed this to the fact that this was kind of a COVID period, so with different habits. So the different habits of the investors and the traders actually contributed, and the different type of traders actually contributed to this. Okay, so then essentially, so what are overall the benefits of trading in the dark pools? Then they offer the opportunity to execute the large orders without being subject to price impact. They contribute to make the volatility lower, and the execution price is typically higher than the execution price in the standard exchange, and the transaction costs are lower. And these are somehow objective benefits of trading in a dark pool. But now, of course, dark pools is not does not have only trading in the dark pools does not have only benefits. There are several drawbacks. Many of them are related to the so-called information leakage, and others to somehow unexecuted orders, delays, and adverse selection, which is essentially of two types. Okay, so dark pools are not completely dark. And some examples of information leakage are the ones that I'm trying to discuss now. So the first source of information leakage is the so-called phishing. So what is phishing? Phishing means to send to a dark pool a series of small orders to detect whether there is a large order in the opposite direction. Now, of course, if you send a series of small orders to this exchange, this exchange where there is not much information going around, then that doesn't necessarily mean that there is a big order and this gets executed. That doesn't mean that there is a big order standing on the other direction. But because really dark pools are thought as exchanges for selling big orders, these are thought for institutional investors, then in some sense this is not a proof, but it's an indication that there is a standing order on the opposite direction. And how can we use this information? Well, actually we can use it to manipulate the price. So if, for instance, we detect that there is a selling order, a big selling order, we can manipulate the price by sending a buying order in the standard exchange and then change the biggest spread. And this does not only affect the exchange market immediately, but it also affects the dark pool. Essentially because the price in the exchange market the price in the dark pool is taken by is taken from the exchange market, and this is based on the midpoint between the national best bid offer. So somehow phishing is a kind of way to detect information from a dark pool that can be used to manipulate the price. Then the second big issue with dark pools is the so-called indication of interest. Now, as I said before, in the somehow historical, so the timeline of dark pools saw a big expansion in early 2000, and this brought a fragmentation of the market. And this fragmentation of the market essentially led to an increase in demand of liquidity in each pool. Now, the operators in the dark pools in this way found it difficult to find a counterparty for the participant of the pools. So what did they do? They were looking for liquidity outside by sending indication of interest. So this indication of interest they didn't need to be reported, actually, according to the regulation from 2005, essentially they are saying to specific people that there is the willingness to execute an order in a dark pool at the mid price, at the midpoint of the best bid and ask. And of course, this is this in some sense generate asymmetric information, especially if this kind of information is not public but has been sent to specific possible liquidity provider. So only few investors were informed of that, and then this as also and then because of that some other people were totally excluded by this type of by a certain trade in some sense. And this is, this is one of the main criticism of this mechanism. The second source of information leakage comes from internalization. So internalization pools. In internalization pools, broker dealers may potentially have the incentive to share information with the proprietary desk. So, for instance, the internalization pool that has Swiss Credit Suisse behind may have the incentive to share with Credit Suisse the information about standing orders. And of course, this can bring somehow a potential conflict of interest with the clients of the pool. Because in some sense, the proprietary desk can make advantage or can use this information at his own, to make his own business for their own gain. Okay. So these are somehow some of the drawbacks that are related to the information leakage. Then there are some drawbacks which are related to the fact that not all the orders that are placed in a dark pool gets executed, and especially if an order is not executed and then it has to come to the market, this only comes later. And therefore, this creates costly delays. And this is somehow what we have discussed a little bit before. So the last some drawback that I would like to discuss is the adverse selection. Now, the adverse selection is something that happens in normal market as well. So in some sense, in dark pool, there are two types of adverse selections, a systematic one and a non-systematic one. And the non-systematic one, of course, is the good one that would arise naturally. The systematic one is the one that one needs to be careful about because it's somehow the toxic part of the dark pool. So what's adverse selection? So adverse selection refers to a price move in the same direction of a certain order. In some sense, when this may happen, just to get a feeling of what adverse selection is, suppose that you want, that you are placing a buy order and the price drops after the order is executed. And to really understand how this works in the dark pool, so suppose that there are two orders in the dark pool. One is a buy order of about, for instance, 2% of the average daily volume, and there is also a sell order of 30% of the average daily volume. Now, what happens is that the buy order gets immediately executed because there is a bigger order of the other on the other side. And the selling order instead does not get executed. So what happens is that the selling order has to say, if it's not executed by the end of the day, you have to go to the standard exchange if you really want to execute this in a certain given time. And because you are placing a big selling order in the standard exchange, then of course this this pushes the price down. So in a sense, in this way, we say that the buy order has been adversely selected by this mechanism. Okay. Now, of course, adverse selection can occur naturally. And this is, in some sense, the good part of the adverse selection, so it's the non-systematic one. Or alternatively, it may come as a consequence of the information leakage, of the asymmetry of information, and this is somehow the systematic one, and that's the kind of effect that makes dark pool in some sense toxic. Okay. So this is more or less what I wanted to tell you about dark pools, and I hope that this has somehow brought you some new information about that, or clarified, or maybe raise some question, give a rise to some question. So just to summarize, dark pools are alternative trading venues where one can trade stocks, bonds, currency, where the information about the standing order, so the volume of the order and the size, the time, the price, they are not publicly available. Trading in a dark pool as a parallel way, as a parallel system to the standard exchange may have a negative effect to the stock exchange, to the standard stock exchange, because of harming price discovery or having a negative effect to the price liquidity, and indirectly this may affect also individual investor. Of course, trading in the dark pool has many advantages. One overall is the fact that the price impact is minimized, even though also from the side of the user of the dark pool, there is no guarantee of order execution, which may generate a delay, and this is somehow costly. Trades in the dark pools are advantageous for many reasons, for lower costs, but of course this comes at expenses of lack of transparency and also information leakage that can somehow affect both the standard exchange and the dark pool itself. So that's more or less what I wanted to say. So thank you very much for your attention. And this is a list of some of the references that I have used for this presentation.
Thank you very much, Katia, for this very interesting and fascinating talk. And
Thanks.
yeah, no, I think that we can open a debate. I mean, I guess there are questions, at least a few questions. And so I think we can now open the debate and see if there are people willing to make questions and
Well, I have a question. Well, thank you very much. This was really very, very instructive. I would have, I think I will start with the general question, and that is, what is so in assessing the benefits or the disadvantages, what is the benchmark, say, that we're using here? I think you mentioned at the beginning that the aim of dark pools is to lower the costs and so forth, right? But often, or at least what I understood, that some of these disadvantages are measured or are made, say, in relation to how they affect the standard exchange.
Yeah.
And so the question here would be, should we take this standard exchange as the metric, say, that we would like to evaluate the dark pool? Or could we say that in some cases there might be another benchmark that we would like to take, say, I don't know if it makes sense, but I'm thinking maybe in terms of what it does for these individual investors. I mean, I suppose that if they're using them is because it brings them some advantages. Or we could see it also kind of in the social, say, welfare, about what is it that we would like the ideal market to do.
Okay, so I mean, this is somehow controversial. It's not simple to answer to this question.
Okay.
Essentially, because so if you think about what happened before, say, 1986, then only the standard exchange was there. I mean, of course, there were private agreements which were not regulated in some sense. So the reason why these the SEC actually brought some regulation was actually that they still know that there was something out there. So this kind of private agreement, and they wanted somehow to bring them to the market. Well, actually, apparently, one could even say, okay, so I would like to measure the benefits and costs, and I would like to create the ideal dark pool where everything is somehow beneficial. Well, I don't think that this is possible. There is a trade-off in some sense, and I think that there are some benefits in trading in the standard exchange as well as in the dark pool. So, I mean, as I said at the very beginning, so the first reason why I started working on dark pools is because I said the questions that me and my co-authors were asking, and this was really merely mathematical, is that suppose that you want to liquidate a certain inventory, and you have the possibility to do that in the standard exchange as well as in the dark pool. Now, what would you do? And how much would you place in the standard exchange, and how much would you place in the dark pool? And what we actually realize is that, of course, this mainly depends on the mathematical model that you are using, is that it's not always beneficial to place an order in the dark pool because of this trade-off between getting executed and at a better price and not getting executed. Then you still have to come back to the standard exchange with some consequences, and the fact that you are coming back to the standard exchange after some time and your price might be lower, in which case, of course, it was not beneficial to go to the dark pool and then wait. But apart from that, I mean, it is not clear with, I mean, I don't think that it makes sense to measure the dark pool in comparison to the standard exchange, because they are somehow interconnected to each other. The prices are taken from the standard exchange, and the dark pool cannot exist without that. And we cannot think as the standard exchange as the best place where one can put an order, because of course this is subject to many costs. And I'm just talking about really like the only from the quantitative point of view. And apart from that, there are some other issues that are related to the absence of information that in some sense are kind of controversial, because I mean, the fact that some people know something and some other are totally excluded is really so we cannot really talk talk about informational advantage, but we are very, very close to that. So
I suppose, let me see if because yeah, I suppose that my question is, in the answer that you gave me, the first example that you gave was, this is disadvantages for the investor who is trying to close a position, right? Because they first go to the dark pool, they don't get this realized, and then they have to go back to the standard exchange to close their position, or to
exactly.
Yeah. So this is what we could say, it's a disadvantage for the investor.
And then there are, of course, disadvantages for the other party. And this is, for instance, the price discovery is one of these disadvantages.
Yes, exactly.
That is not, I mean, this really depends on the point of view, on the point at which you are looking at the problem. So
okay, so that is exactly, I suppose, what I was trying to get to, that maybe it would be nice to see exactly according to what is the metric that you're using. So say, for instance, for investors, the advantages and disadvantages is such and such. For the market, it's such and such. You see, so that it would be easier somehow to see these disadvantages.
Yeah, thanks.
That is what I was trying to get to, because it wasn't clear to me whether you had a specific perspective, or these are all being discussed next to each other. That's, I suppose, what I meant.
Yeah, I mean, this was, so I tried actually to categorize the advantages and the disadvantages. I mean, for which person there is an advantage, for which person there is a disadvantage. And I came out with too many things. And then I had to select somehow. So I said, okay, I will talk about some of the somehow the most prominent advantages and disadvantages, but I do understand that I might have not been as clear as
well, I mean, because so perhaps what I'm trying to get to in the very, I'm sorry, I'm not being very, very.
No, but this is very useful to me.
Because I think that there would be cases that are more interesting than others in some sense. So let's say that whenever there are advantages for the investor, but disadvantages for the other market participants, where there's a clash, this might be something that might be, I don't know, maybe more interesting than whenever it's disadvantages for the entire, for every participant. Yeah. I don't know if there are these combinations of cases, but this, I suppose, pairing them could also give a little bit more clarity, I suppose, over certain features of the entire dark pool. I don't know.
Yeah, I mean that's a very useful comment. I will take it into account for sure. I mean, you're right. That's exactly the type of things that happen in this situation. So there are some things that may affect positively one side and negatively the other side. There are some things that one side does not even see, and the other side has big advantages or big disadvantages, and they do not necessarily interact to each other. But yeah, so I really wanted to give somehow an overview of what would be the advantages and the disadvantages, but I do understand that it's, so the point of view was not always the same in the whole presentation. This could be somehow misleading in some sense. I'll try to be as clear as possible next time.
No, it was really very clear. It's it's just that it's also a lot of stuff.
Yeah,
So thank you, Melissa, and thank you, Katia. Any other question from the audience? So yeah, I mean, maybe I have a question which in a sense is connected to what Melissa was saying, in the sense that of course we have a kind of impact of dark pools on public markets, and so and that's quite clear from what we have said today, in the sense that prices can be manipulated, volumes can be different because of the existence of dark pools. So maybe it could be interesting. I'm not saying to measure, but to understand the impact of those dark pools also from a historical viewpoint, in the sense that now there are more or less 60 dark pools in the USA,
US,
more or less
something like 40 in the, I mean, a bit less in
Europe.
In Europe.
And maybe it could be interesting to see what happens from a historical viewpoint, in the sense when the number of dark pools increases, what happens to the public markets? Because maybe there are thresholds.
Yeah, I mean, there are some studies about that, about these specific years and what happens around these years. Essentially, the development of the market, as you could see from the historical point of view, was related to the launch of new regulation by the SEC. So there actually, in each of these dates, there was some kind of a push in the use of dark pools that actually had an impact. But what I mean, there are also many say colleagues working on in quantitative finance, so to say, that are also not aware of the existence of the dark pool, and this is, in a sense, I mean, at least to my point of view, this is due to the fact that, in fact, the dark pools were not so big. So the trades in the dark pools were not so big up to a certain date, and it seems they have exploded lately, but say up to 2008, 2009, they actually were something like 10%, 12% of the total transactions. That's not a huge, I mean, it's big, because 10%, 12% of the total transactions in the US market is something big, but it's not like 50% or 70%. So there were people that were, of course, worried about the consequences, but since they have gained a huge percentage of the market in the last years, and that is in some sense also surprising to me, then now I think that it really makes sense to see what are the consequences on the standard exchange of this huge trading in the dark pool, in some sense.
Yeah. Thank you, Katia. Yeah, I have another question. I don't know if there are questions from the audience. So in that case, I will give precedence to them. And
well, I have a follow-up on that, I think, but maybe, yeah, you go ahead and...
No, Melissa, you can go. You first.
Thank you. Something else that I was thinking that might be interesting, or at least that made me wonder, was you mentioned that 1971 was when the Securities and Exchange Commission allowed for this securities to be listed and traded privately.
Mm-hmm.
And so my question would be, okay, what was, I mean, at least as I understand it, most of these rulings or regulations from the Security and Exchange Commission is trying to, they have, as I see it, two main features or two main purposes, which is to protect customers or to generate or to have financial stability. I don't know if that was the case at that time, but most of the regulations come for the sake of, you know, for preventing something bad from happening, right? So my question would be, or at least, what was the Trading and Exchange Commission doing when they allowed this? What was their purpose when they allowed this to happen? What is it that they were trying to solve? And in a sense, this, I suppose, could be interesting because it might be like, okay, was the emergence of dark pools unintended consequences of this ruling, or was it something that they thought would be solved, was solving a problem that existed in the, you know, in the markets as they were in 1979? And I think that this might also give some kind of, at least, you know, a point of view where to judge the benefits and the disadvantages, right? So if it's an unintended consequence of what the Securities and Exchange Commission did, could say, well, this was, you know, disadvantages on the basis of what they were trying to solve in the first place. And the same for the benefits. I don't know. So I suppose that it was a twofold question. One was, why did they have this ruling or this regulation? And second, maybe more a comment on that basis. Perhaps this could be helpful to elucidate and to classify, say, what are the benefits and the negative consequences of dark pools.
Okay, so to be honest, I really don't know, in the sense that this is a part of dark pool that I have been investigating really lately, because before that I was really just interested in how to model this from the mathematical point of view, and now to get tangible results that says, okay, you should do that if something happens, and you should do these other things if this happened. So the history of dark pool was somehow something that I took it as it was, without really asking myself what was going around in 1978. I mean, that I don't know, but I think that this is something that I'm not sure. So I really don't know if they really want somehow to give a feature or give a name in some sense to something that was already existing, or if this was just an unexpected consequence of this regulation that they did for some other reason, or maybe for they were some requested by some parties that I honestly don't know. But yeah, of course, this might help to explain what are the advantages and the disadvantages of these trading venues, and also to better identify the benchmark with which we want to measure this. But yeah, I mean, I don't know exactly what was going on in 1979.
Thank you, Katia. And yeah, just one final comment question. Maybe I don't know if it's the right place to do it. And yeah, so we have learned that there are several shade darker, quoting a movie. So we know that the dark pools are not totally dark. And so I'm trying to reverse the table and thinking of the light markets under this view, in the sense that they are not totally light.
Yeah, of course.
In the sense, especially because
about insider trading, in some sense, they are not.
I'm talking also just looking at the data, in the sense that there is a dark point. Which is the identifiers of the bank accounts, in the sense that we don't know who is doing what.
Sure.
So maybe it's an exercise of financial science fiction, I don't know, but maybe it could be interesting to imagine how light markets could work if this piece of information could be available. And so to have light markets or public markets. And so I don't know if there are something, I mean, some work or some idea on this in this opposite direction. And
I mean, not as far as I know, apart from, as I said, some investigation of insider information, kind of, which I think is somehow related, because the fact that there are some people that are more informed than the other, this is a fact, and of course this affects the transactions and all this kind of stuff. But yeah, apart from that, I mean, I don't know, but it would be interesting to look at the light side of the market. Which is not totally light. I mean, it's not totally enlightened. Yeah.
So thank you again. I don't know if there are other questions from the audience. Otherwise, I think that we have to thank you again.
It's been a pleasure to give this talk.
It was our pleasure, I guess, and it was very instructive and fascinating. And
I didn't want to be too technical, but this is somehow a little bit out of my comfort zone. So I hope that at least something has remained.
Yeah. I mean,
this is great. This is great. Really, thank you very much for your talk. It's really fascinating.
Yeah. Okay, I think we stop here. And thank you again, Katia, and also Melissa, and all the other people here.